to give you this brand new iPhone XR worth rupees 53,000 for just rupees 20,000. Would you like to buy it? Would you go ahead and make the deal right away, or would you take out a moment and think suspiciously that why am I giving you this iPhone at such a low price? I'm sure you would want to know the real reason behind this lower price, right? You would want to know whether the product is damaged or broken, or is it even the original model for that matter, right? But while investing in stock market, the beginner investors overlook why a stock has been given a low PE ratio. And more often than not, they learn only by losing their hard-earned money in the market. Namaste everyone, welcome to the Money Master. I am Pooja Sharma, and in this video we are going to talk about the PE trap. Have you heard about the 2009 Satyam Computer Services scandal? Let me give you a brief. Mahindra Satyam was an Indian IT services company which was founded by Ramalingam Raju in the year 1987, 6 years after Infosys. But the company was getting a PE ratio that was lower than both Infosys and TCS. Now, if you just use PE ratio to value the stock of a company, Satyam Computers at that time looked like an underpriced stock. But there was something suspicious about the stock which the market had sensed, but it was not so obvious to the investors. And finally, in 2009, Satyam went bust, and it was a perfect example of the low PE ratio acting as an advance warning signal. Now we are going to talk about 6 major cases behind a company being given a low PE value in the market, and these cases will come in handy when you will conduct fundamental analysis of any stock or share to invest in. Case number 1. Good historical earnings, but the future growth is missing. The perfect example for this kind of company is ITC. ITC had made multiple attempts of diversification, starting from hotels, information technology, to finance, fashion, paper, matches, and whatnot. And those attempts have not worked out as well as the investors expected them to. Apart from this, their cigarette business is hugely affected by adverse government regulations and infiltration of the illegal cigarettes. And on the basis of all these factors and not having faith in its capital allocation strategy, the market has given a low PE ratio to ITC stock. But that doesn't necessarily make ITC a bad company to invest in because its other fundamentals are strong. And this, of course, is no stock recommendation. Case number 2. Fraudulent company with earnings only shown in the books. The perfect example of this kind of company is Kingfisher Airlines. Kingfisher established a great reputation as one of the India's finest private airlines with high quality service standards, and it even enjoyed the second highest market share after Jet Airways. But the company went on to borrow funds by all possible means, including related parties, and even to the extent of pledging Kingfisher brand by overvaluing the brand. Unfortunately, the good times didn't last long, and it had to cease the operations on 12 October 2012. Case number 3. A company which is part of a glorious but dying industry. Remember Mozabear India Limited? Yes, we all have childhood memories connected with this company. Remember how we used to download and save thousands of songs on our DVDs, Mozabear DVDs? But with the rapid development of pen drives, online streaming, and the growth of cloud storage, we all shifted from offline DVDs to online OTTs, and this resulted in a low to negative PE ratio for Mozabear. Case number 4, the cyclicality factor. If you haven't watched our video where we have talked about cyclical stocks versus defensive stocks, I highly recommend that you go and watch that video. Majority of the value investors get trapped by investing in a cyclical stock at the time when the earnings are at its peak, because when the earnings go down, the PE ratio jumps up. So now let's do some working in the Excel sheet. This is the working for the cyclical stock. Cyclical stocks, they have 2 periods. One peak period and the other one is lean period. During the peak period, the sales are higher, and accordingly, the earning price per share will also increase. And accordingly, the EPS will be lower in the lean period because the earnings are also less. Now, if we calculate the PE ratio, wherein we have to divide market price per share by the EPS. Okay, so during the peak period, the PE ratio is coming out to be 0.5, wherein during the lean period, the PE ratio is coming out to 2 because the denominator is really, really low. Now, what investors do is they think that during the peak period, the PE ratio is really low, so we should invest in it. And that's where they go wrong. So it is advisable to invest in the cyclical stocks at high PE and take an exit when the PE is low. Case number 5. The industry impact. The industry to which the company belongs also play a significant role in determining the PE of that company. For example, the stocks in the consumer-oriented sectors are available at higher PEs because these are considered as growth sectors, while there are stocks which belong to the steel industry that always trade at a lower PE value because the prices of the steel are very much vulnerable to the global shifts. Now, the beginner investors like to think that the stock is available at a low PE ratio, let's grab it. But the reality is that the same stock has a history of trading at a low PE value. For example, Tata Steel, which is always traded in the PE range of 7 to 12. Now, does this mean that I am recommending you not to invest in the steel stocks? Definitely not, because there are other fundamental reasons which we have to consider before investing in the stock. But don't get tricked by the low PE ratio. That's the whole point. And finally, the case number 6. Company with fraudulent promoters. If a company has mistreated minority shareholders in the past, these stocks tend to have a bad reputation in the market even though they have a good business model. Since there is a risk that they can cheat the shareholders again, they tend to trade at a lower value as compared to their peers. The perfect example of this is Leel Electricals. Leel's share price was trading at rupees 250 in the year 2018, which crashed down to just rupees 12. Why? Because it came to be known that a huge chunk of cash was moved out of the company and the promoters, Brij Raj and Bharat Raj, were blamed for that. So the key takeaway is the next time you're doing company analysis and you're looking at the PE ratio to find out the value of the stock, look at the PE ratio with skeptical eyes. Consider what premium are you paying for companies' earnings today and determine if the future expected growth deserves that premium or not. Also, we must compare the company with its industry peers to know whether the premium that we are paying is worth the cost of investment or not. So with this, we come to the end of the video. Hope you enjoyed the video. If you did, give it a thumbs up. And if you really liked it, you might want to share it with your friends. So do share it with your friends. And if you have not subscribed to the channel yet, what are you waiting for? Come on, subscribe it right now. In the next video, we are going to talk about why a high PE ratio company might not be a bad investment at all. So wait for that. It'll be an amazing video. Till then, namaste, bye bye, and take care.